Joining us now for a technical look at the market, Chris Verrone, Strategas Research Partners, head of technical and macro research. We'll start with the stock market, I guess, and we want to talk bonds also. So is this is there more to come, or are we at the high end of a range in your view?
Well, so I've been thinking about it this way. This entire move has come against the backdrop of an inverted curve. And we went back and we looked, what were the largest rallies ever with an inverted yield curve? You have two big outliers. 1979, you get about a 30% S&P rally, and the curve was inverted the entire time. And mid-06 to mid-07, I think a period we remember well, 30% S&P rally with an inverted curve. So if we put 30% on the October lows from last year, gets you about 4,500. So we trade 44.25 today. My suspicion is we're pushing up against the higher end of the range. But at the end of the day, the trend is the trend, and you can't fight the trend. And that's just history, and we have to respect the price momentum here. So I would watch two things. I'd say, number one, when we've seen markets falter in the past, it's with leadership changes. This has been very pro-cyclical leadership, particularly the last several weeks. So I think if something's going to change, that would have to be the knife's edge, and there's no evidence of that yet here. The reason that I said we'll start with stocks is because in terms of yields, you think we're going to break out to higher yields. And I'm trying to decide whether that would mean the economy is in pretty good shape, which could be good for stocks, or it could mean that the doubt that the bond market has had that the Fed's resolve, maybe it's been wrong, and the Fed does stay tighter for longer? Well, I think that's certainly the message of yields here. And it's this very unique backdrop where you've actually had some softening in the economic backdrop, yet you have yields up. That's particularly true in the UK. It's recently true in Germany as well. You've had 10-year yields here basically chop for 8 or 9 months. 390, 395 is a big level. I think certainly anything above that, step aside and let them go. The move we've seen in UK 10-year yields over the last 3 weeks has been explosive. And the move we've seen in German 2-year yields the last several weeks has been explosive as well. So I think if something's going to upset this market, my suspicion is it would be what upset it last year, which was yields running away. So look at 10-year real yields here as well. They've broken out over the last several days. That, I think, is going to be the big test for the second half of the year. This whole move in equities has been against the backdrop of a very, very tranquil yield environment. I think if that starts to change, your antenna has to go up.
What is causing yields to go up?
I think
fundamentally, not technically. Or do you even care? Do you even have a reason?
So intellectually, I have a reason. I'm not sure I should let it impact my thinking. Right? I'm in the business of price and volume and trends and momentum.
I'm just trying to, because everything's so perverse in the financial world that, bad times sometimes end up with good effects on stock price. It's so messed up the way it works. But I would think higher yields would indicate that we have a pretty good economy. If it's not going to, whenever we see a flight to safety, a bank fails, you see the bonds rally.
Joe, I think that's where this relationship between yields and leadership is going to be important, right? Yields up with pro-cyclical leadership, I think, is suggestive. Okay, economy has some momentum here.
It's no recession.
We start to get worried when it's yields up and defensive leadership starts to creep in. Remember when that happened? That happened in like second half 18 into 19. It happened in summer of 07. We're like, okay, why is the equity market leadership differing from the message in yields? That, I think, is what we need to be on guard for over coming weeks and coming months.